Hello everyone, today's video I'm so excited to interview Dahlia Barzum, CEO of Streetwise Mortgages. Her and her team have decades and decades of experience helping real estate investors in Canada to buy their first or next rental property so that they can ultimately scale their rental property portfolio and build more passive income so that we can all achieve financial freedom. Now, in today's video, we're going to talk about qualifying for a mortgage in this high interest rate environment. As you may know, qualifying for a mortgage right now, it's getting harder and harder. But in today's video, we're going to talk about two strategies and lots of tips and tricks that you can do right now to help you qualify for a mortgage in Canada so much easier. So if you are a real estate investor or an aspiring real estate investor looking to buy more rental properties, then you definitely want to check out today's video. Hi, Dahlia. Thanks for coming on to my show. And we're going to talk about something that I think it's really, really important. It's about the Canadian mortgage stress test. Now, I know you have some strategies. I'm so excited to hear about it today. So why don't you explain to the audience, like what are the changes, if any, and how do we navigate this in this harder environment?
So, Tracy, we're essentially going to talk about mortgage qualification and the fact that it's gotten tougher recently as a result of the increases in rates. And I just wanted to do a quick refresher as to why things have gotten tougher and remind everyone that in 2018, there was something new that got introduced called the stress test. And essentially, what the lenders started doing in 2018 is, let's say you're applying for a mortgage and you're getting a variable rate mortgage at 2.5%. And what they started doing is they started to say, okay, Tracy, you're getting a mortgage at 2.5%, but we are going to assume in how we approve the deal that you're paying a higher payment to protect, when the time comes where rates increase, to make sure that you can afford the higher payment anyways. So they started to do this. They started to say, okay, we're going to run the payment based on two numbers. One is the 2.5% that you are getting approved for plus 2%, so 4.5%, or 5.25, which is the Bank of Canada rate. So they're taking a payment at the higher of the two. Keeping that in mind, and knowing that interest rates have been rising over the past few months, we are now at a point where the rate plus 2% has become higher than this 5.25. So they are actually qualifying a refinance or a purchase at a higher bar. If you're doing a renewal, it doesn't impact you. But if you're doing a refinance, equity takeout, a purchase, now the bar that we have to jump over is higher. So what does this mean? It means taking up potentially less money or having to switch from one lender to another and pay a higher interest or putting a higher down payment. And these are the things that we want to deal with through some strategies. And that takes me to the next point about what can we do here to continue to qualify, to continue to move forward and maintain the momentum that we want to maintain. And that's my next topic about the types of strategies the audience can utilize.
Awesome, because I want to hear about it. So the first strategy, okay. So I hear you. You say you could pay down, have a higher down payment, which kind of sucks. And next one is you're losing purchasing power. And what was the last one? Was higher interest rate.
If, let's say under the lower rates, you could get approved with an A lender at a better rate. And now as a result of the tougher qualification, the deal no longer fits the A lender's box, and we have to move to the next group of lenders that may charge a higher interest rate.
Okay, but I hear that there are two strategies that we could use that possibly could stay with a same A lender or not even put in a higher down payment, right? Is that the two strategies you can share? Okay, I'm very excited to hear about it. So let's hear about the first strategy.
Yes. So essentially, approvals and financing is a numbers game. And there are two levers that play into the numbers: debt and income. right? So I'm going to talk about debt strategies, debt management strategies, and income strategies to help the numbers. So let's first talk about debt management strategies. Debt management tools or strategies are essentially tools to help manage the monthly payments on an application. So let's say we have a car payment that is standing in the way. Doesn't matter how much the loan amount is on that car. Maybe there is $5,000 left, but a client may be paying $1,500 a month. The lender doesn't care about the $5,000 that's left. They care about the $1,500. That eats into the numbers. Another example is a credit card where somebody has a $10,000 balance on a credit card and they're paying just an interest payment. Well, the lenders are assuming they're paying 3% on that 10,000. So that's $300. Like if you take 10,000 multiplied by 3%, that's a much bigger number, is my point. That's how they think. So the debt management strategies aim to target these high monthly payments that are standing in the way. And what we do is to say, okay, where can we pay certain things down to clear the path? Or can we maybe pay some expensive debt with cheaper debt, like secured line of credit? Money is cheaper to pay credit cards with or a car payment with. So in the eyes of the lenders, now this high payment is swapped with a much lower payment. That's the idea behind debt management strategies.
Okay, that's good. I mean, I really like that strategy of swapping for what you're basically looking as a lower interest rate type of line of credit versus a high interest rate credit card. But my question is like, as you're talking about that $10,000, credit card and your 3% interest rate, what if you had a credit card like sometimes Home Depot offers 1 year, no payments, like interest free? How does that impact a lot of real estate investors? Because I've totally taken advantage of that renovating my properties.
Yeah, that's a great question. And many investors do use a Home Depot credit card or some sort of a credit card with a promotion of not paying for 6 months or get it now, no payments, pay later. And whether you're paying or not paying, the lenders are going to assume that you are making a 3% of that balance as a payment on the application. So again, it is not about whether or not you're paying it or whether it's zero interest credit card. That's not how they look at the payment. They will assume a 3% payment on the balance. And that's what throws the numbers off sometimes for clients. They think, I'm not paying anything. And the lender goes, oh, your application got declined. It's because they're taking a payment into consideration regardless.
Okay. So I'm just curious about the 3%. Is that just what prime is right now? Or how did we get to 3%?
The way they calculate the payment on unsecured debts.
Oh, okay. Unless there's an exception where the credit card has a much higher interest payment, right? Is it like 3% flat or it doesn't?
It's a 3% with many lenders, 3% of the balance. And
Oh, of the balance.
typically that 3% is a higher payment than the interest only payment that the client is making.
Now, is this the same with buy now, pay later type options and Affirm and all that? Or I've also found like you could even buy air conditioner because I actually did this. I bought an air conditioner and I bought a new furnace and a pool heater, and I was like, oh, I don't have to pay interest payments for a whole year. I could just do like interest-free loan basically. So how does that get calculated? Is the same thing?
Showing on the credit report as a trade line or you're getting it financed, then the idea is the same. I'm not saying don't take these types of cards or don't assume that all debt is going to work against you. That's not what I'm saying here. All I'm saying is we got to take a look at the debt on your balance sheet, whether it's secured, unsecured, car payments, investment loans. Take this now, pay me later, and see what is standing in the way in terms of approvals. And we then have strategies to clear these debts or shuffle these debts around so that from a lender standpoint, they're using lower numbers, which would help you qualify under, not push the ratios above the lender's guidelines, essentially.
Right. Okay. Thanks for that. Now, I want to hear about the next strategy, which is about your income, right? It's about managing the income. So, what are some tips and tricks that you use for your clients?
So, when it comes to income, it's about how can we make the numbers work better? What can we add to the application, either through personal income or rental income to help the numbers. So on the personal income front, typically if you're salaried and you're on regular payroll, there isn't much to do with a salaried client. But if you're a self-employed client, it's about sitting down and talking about how much you need to pay yourself from the business, whether it's a salary or a dividend or a shareholder loan or a combination of both, and for how long to actually improve the income on your application to make your deal work. That's a planning discussion before a self-employed client files their income. That's one area of focus. The other area of focus is rental income. So if you have a rental portfolio, how can we use the best rental income possible to support the numbers? Meaning, let's say you have a rental property where you're renting below market rents. Some lenders will only accept a lease. They will go by what you're renting it for. However, there are opportunities to get an appraiser with some lender to give us an opinion of what the market rents are at. And if they're higher, we can use them. And now that helps your numbers again. We don't have to go by the lease. We can go by what the property could potentially rent for through what's called an appraiser's opinion of market. So little tricks like that on both ends to bring the debt down and to push the income up is what opens up borrowing capacity for clients. So they can get qualified for the amount that they envision. They don't have to put a higher down payment, and they can still qualify with the lenders that would give them the better terms, essentially.
Or a business owner, where they can have the option of paying themselves either more salary or versus dividend or doing a shareholder loan. I was curious. I never heard about how a shareholder loan would be considered income. Like when dividend, I've like in my experience, just going through these ropes for many years, is like I found that having dividend income or as long as it's not salary income is like it just seems harder to qualify for a mortgage. Is that?
Let me clarify. So with respect to the shareholder loan, it is a return of a shareholder loan. So it's money you're getting back from the business. It's not the shareholder loan. It's a return of a shareholder loan. But the two, and not every lender would consider a return of a shareholder loan as income, but some lenders do. The two primary buckets of income for self-employed clients, like you said, are salary and dividends. There is a misconception that if you pay yourself a salary from the business, that you would qualify better. Not true. Because at the end of the day, whether you pay yourself a salary or dividends, it doesn't matter for the lender, for the A lenders at least, because they would look at 2 years average or the 2 years history to use that income. They wouldn't look at just a salary paid for 1 year as income from the business. For the A lenders, it has to be a 2 years history. And it doesn't matter if it's salary or dividends, as long as we have the number, essentially, that works from a financing standpoint. But for your accountant, it may be a different story. They may be encouraging you to show dividends or pay yourself a salary for tax reasons.
Really interesting. Glad you totally shared about the salary being being like a myth. Okay, because I was on that. I was like, oh, it must be salary because people like salary, but obviously not true. Now, getting back to what you were saying about being employed, that there isn't many options, meaning if you're on payroll, that you get a regular paycheck and there isn't many levers other than maybe, having obviously higher rental income because maybe some of your properties are not getting market rent. But a question for me is like, what if you have rental properties and you've been depreciating your property through the depreciation, annual depreciation? Does that have any effect on the mortgage qualification? Because you do have to submit tax summaries, like the last year's tax return. And I'm wondering, like, does that impact the mortgage qualification process?
For 99% of the lenders, they do not care about the depreciation of the property. They really take the gross rents you're charging or market rents, and they deduct expenses, and every lender has their own methodology around what these expenses would look like. Depreciation is rarely in the mix.
Oh, okay, good. Because I was always under the impression that, oh gosh, should I depreciate? Should I not? But looks like it does. It really, most of the time, has no effect.
An accounting expense, for lack of better words, is not a real expense. The lenders care about the real property expenses.
So it sounds like they calculate their own way of determining what type of expenses you have on your rental properties, right?
Just say, you know what, we're going to take a 50% buffer for expenses, and they don't care what's in that buffer. And then some lenders will look at your tax returns and they'll go line by line. Oh, you spent this much on property management, on water and heat, blah, blah, blah. So every lender is different, but depreciation is rarely an item of concern. And Tracy, on the topic of buying rentals, this is the qualification has become challenging even for first-time home buyers, those who are looking to buy a primary residence. So these strategies that I discussed also apply for clients who are looking to buy a primary residence or a second home. Everybody is facing the same issues right now. And for clients who are salaried, I did mention that there isn't a proactive way to plan their income like self-employed clients, but for some of these clients, if there is someone who can come onto the application and bring income to the application as a guarantor, that's an option to add more income to the application. And it doesn't mean that they need to own 50-50 of the deal. It could be that they own 1% and they own 99%, or they're simply a guarantor with no ownership, but they're bringing more income to the deal.
Right. Okay. So like a mom or dad or a relative that could become partnerships. Okay. And don't have to be, do they have to be on title though? Because of that?
No, no.
No.
A
Okay.
guarantor doesn't have to be on title.
Well, thanks for that. That was really, really, really helpful because I'm just thinking definitely for our kids, my kids who are going to grow up, I'm like, I think I'm going to have to like co-sign for them in the future. So, for aspiring real estate investors or real estate investors who are looking to buy their next rental property, and definitely should be doing a lot of planning, considering, it sounds like it's getting harder and harder to qualify for a mortgage because of the higher interest rate. Where can they find you? Because your team is a wealth of information.
They can reach us by emailing us at info@streetwisemortgages.com for any questions or to set up a complimentary planning session.